Today, just want to make sure, quick test of audio and visual. You guys can see the screen and you guys can hear my voice. Give me a Y in the chat box. Everybody's good, and I think we're all good. Hey, David, everything's good?
Yeah, looks good.
Perfect. Well, thanks, and first and foremost, thanks to the hosts for putting on this event. I always enjoy being able to come in and participate in these. And David, it's been a long time, so thanks for having us in. And thanks to you and your team for bringing us in. That's always a blessing to be around like-minded traders. If you guys haven't heard of Street Trading Academy, if you're new to us or if you've never been to an event that I've presented at, or if you've never heard of the company, you can go to nstradingacademy.com. And there's a lot of great resources on there. Ultimately, you definitely want to be a part of our YouTube channel. We're very active on that with lots of webinars, strategies, Money Mondays, TV shows, you name it. So check us out. There's a free mobile app you can actually download. I'm going to give you a link to that after, but if you're interested in browsing around later tonight or on the weekends, definitely want to check out the site. There's lots of great stuff up here. There's social media links. You can check that out and take a look at that when you got some time. So what we're going to do today, guys, is I want to get right into the meats and bones of this, because I really think that when David actually asked me to come in and present, he said, we're doing an event on Fibonacci and wave analysis, you know, and I said, yeah, that's right up our alley. And so I'm really excited about the presentation here, because I really kind of just want to get into the charts and talk about strategies. I really like being able to teach strategies. I just love building systems and teaching traders different system architecture. I think that's the developer nature in me, but more than anything, I think you guys are here to learn some things that can actually be taken from here and really kind of understand how wave rotations and Fibonacci can be a very, very powerful combination when you understand how they kind of mesh. And we're going to focus on trend trading. I believe that directional trading is much easier than reversals if you're new or just getting started, but that's obviously a preference. And hopefully you guys learned something. If you have any questions after the event, we are recording it, as David said, and just type them in the chat box. And if I don't see it right away, I'll get to it, and let's get started. So quick disclaimer, as always, I need to cover this, guys, because we are active traders and it is a risky business. We need to make sure that you guys are aware of the risks and able to you know, undergo that. We're here to educate and instruct, but not to advise, right? Past performance never guarantees future results. So got an agenda, keeping it super simple, guys. Going to go over a little bit of credentials for myself, so you guys know who I am. Talk about some of the desires and struggles that I think a lot of you have either faced or facing, or, you know, maybe will encounter. I want to talk about how we automate wave analysis. I believe that wave analysis is a very difficult process. It's very mathematical, and if you get it incorrect, it can be a very dangerous process. Waves is a form of market geometry, and it can be very cumbersome if you're trying to draw it manually. I wouldn't want to draw it manually. I don't know anybody that really could do it accurately unless you're a specific wave trader and you've been doing it for a very, very long time. Especially since the markets are dynamic on a daily basis. No wave count is ever the same. And so we always need to be able to adapt to the dynamic market. We automate our fib levels. There's a whole lot of different ways to fib. There's retracements, extensions, measured moves, you name it, zigzag analysis. We actually use Fibonacci confluence. And the reason for that is it's much more powerful than standard fib levels. And we'll talk about how we do that and what that is. I actually have a strategy. This strategy I've presented before, and it's very clean and it's very, very simple. The reason it's super simple is it allows you to be able to identify when you're in the right conditions on the waves. For directional trading, you definitely want to be on an impulse wave. If you catch an impulse wave, you could catch some really big trades. If you're trying to fight, you know, a non-directional environment, or if you're trying to fight the wrong wave of a market, what can happen is you could try to trade a trend in the wrong environment, and that often happens with new traders. So I'm going to do a demo. I can show you stocks, futures, and forex. And I'm not a really big believer in cherry picking trades. Like I would rather ask you to let me cover a market. Like I'll ask you to give me a futures contract. We'll look at a forex pair or even an equity market, and if I've got data for it, I'll pull it up. But what it is I'd rather you just tell me the market, and I'll just go and find a market that I haven't even looked at today, and I'll just show you how this stuff works. So it's super, super effective. Yeah, we can take a look at that, Adam. And then at the end of the event, if you like the tools and the resources that we have, at very least, we're going to give you a free app and we're going to give you some free goodies. And you can check us out in our trading room. But if you like the software that we're talking about and the systems and stuff we're doing, we've put together an offer for David's presentation here and for us to be here. And you guys can check that out. So that being said, no fluff, no snake oil, no false hopes. I believe there's enough tarnished stuff going on in this industry. It's a pretty dark market, no pun intended, with a lot of stuff that really shouldn't be out there. And I really believe that it's trading is a journey. Everybody goes on it, and we don't know where we're going until we decide to stay in it or not. And a lot of traders never stay in it because they're not capitalized to last. And then the other ones are they just refuse to quit. And those people that refuse to quit are the ones that we normally work with, and we normally see the gold at the end of the tunnel because, you know, we're an educational school and we've worked with thousands of traders. That's something I'm really passionate about because I love to work with people that like to trade and like to learn. I believe Tony said in the previous presenter, you know, she wouldn't be as good as she is if she wasn't teaching. I truly believe that we can't keep what we have unless we give it away. So I'm on the same page as that mentality. And the reason I think that is because you're never stopping learning, right? Like we never stop learning. And in fact, you know, I've been learning like crazy the last year, and I've been trading for 10 years. And, you know, that's what I love to do. I love to teach traders how to learn their signature trades. Their execution is the most important part. You could learn a lot, you could know a lot, but if you can't trade it, you're rendered useless in the market. You know, the big thing is studying and being able to progress from that study. Knowledge does not equate skills. So the reason I like that is that we have a lot of traders that have proven what we teach them works. I rather let them share their experience. And if you ever want to speak to any of our traders, or if you want to get in touch with anybody in our company or anybody of our community, just shoot us an email. We can definitely put you in touch with a list of people, or even better yet, have you come into our classrooms and you know, just we open up the chat room. You can just ask there, right? So that being said, I know we're all here for the same 5 things. Maybe you guys can give me a yes if you agree with me or not. I'm just going to keep it super quick and simple. How many of you guys think that these 5 bullets on this slide are absolutely important, and that these things are something that you're looking for in your business? You know, better results, believing in your system a little bit more efficiently, easier trade setups, cleaner opportunities. Anybody here want to depend on their ability to make money on a regular basis rather than just hit it or miss it? Right? These are the desires that we all have, and the reality is that we all have the best of intentions coming into this business, and what happens is the market slaps us with some humble pie, right? And that's when the real work gets put in. And I think that's the beauty of this, right? Is that, you know, if you're willing to do the work, you can actually have these things. And what happens is traders end up going through different problem sets. So not everybody struggles with the same thing, right? Some traders are great at execution, but terrible at trade selection, right? Or some traders trade the wrong markets, but they have a great strategy. You know, there's a lot of different things that a lot of people struggle with. The 5 things that I find that traders struggle with are identifying good and bad trades. So knowing the difference between a good versus a bad trade. We can never control the outcome, but we can definitely control how we participate in the market. And a lot of times I see the biggest struggle is having an incorrect bias for the system that they're trading, right? Like they'll normally have a trend trade mentality, but they should be trading a reversal at their areas, or vice versa. And, you know, sometimes, you know, the expectation of what they should be getting out of a trade is wrong. FOMO, greed, discipline, second guessing, I think is the most important one here. If you're second guessing your strategy, it's because you don't believe in it. And that's a hard pill to swallow, right? Like if you're not believing in what you're doing, it's a difficult place to be. And, you know, complicated systems, it really just depends on what's complicated to who, right? Some traders, you know, like more advanced analysis, and some traders like simple things. I'm here to tell you that we trade both, right? So we've got some pretty complicated analysis tools that are, you know, high level algorithms with, you know, quant scanners and you name it. But then we've also got very simple trading systems that are very, very basic and very easy to understand as well. And it just really depends on how you prefer to trade. So what I want to do today is I want to give you 5 solutions using waves and Fibonacci. And the big thing here is to make sure you understand the best waves to take. okay, which means riding the right wave. Get your surfboards out, get the waxer ready to surf, because I'm going to teach you how to see that. And understand how to identify the difference between weak fibs and powerful fibs. And actually, you don't even have to do that. Our software does it for you. So you never even have to worry about fibs. We can handle that for you. The big thing for me is simple trade management. The only way you're going to have simple trade management is if you have rules-based trading. Rules-based trading means you stick to them. Doesn't mean you change them. Doesn't mean you adapt every single day. It means you stick to them, right? And the best way to stick to rules is to have a step-by-step process, which is normally how most people learn anything, is in a linear environment, right? Like if you want to learn how to lose weight, you got to learn how to eat, learn how to exercise, learn how to rest, learn how to hydrate. Like there's a process to it, right? You want to learn how to have a healthy relationship. Well, that doesn't mean just always being the one that talks. You got to listen too, right? Like there's many things to do in learning, and in trading, it's a linear process. And so the reason for that is our brains think in linear environments, right? We can go step 1, step 2, step 3, step 4. What happens is a lot of traders will try to jump from environment to environment and they can't figure out where the disconnect is. So what I'm going to do is I'm going to give you that framework today. I'm going to give you that environment so you guys can see that process, and that way it'll help you make better decisions as you unfold the strategy that I'm going to teach you, okay? So let's talk about automating wave counts. The reason we automate it is because I truly don't want to have to be the one to do it manually. I like to keep it super simple, and if I can use software to make my information more efficient, I'm all for that, right? Trading takes enough time as it is. I'm somebody that really likes convenience in the market. I've gotten spoiled in that way, and I think that's just because I develop software and we build systems, and it just makes trading a whole lot more efficient, right? Now that's my take on it, right? Everybody has a different perspective, and after today, you can be able to assess that for you, right? So 4 problems traders face with waves. They overcomplicate it. They use them in oscillating markets. Wave analysis is not meant for oscillating markets. If you understand that, you're in a way, way better shape than 90% of the people trying to trade wave analysis. Wave analysis only can work if you have impulses and corrections. If you have an impulse followed by another impulse in the other direction, followed by an impulse in the other direction, well, you're not in a waving environment. You're in an oscillating environment, which means trying to trade waves will not work. Like it's rendered useless. That's like getting on the freeway and driving backwards. It doesn't make any sense, right? So the key here is to know the trending impulses in corrective environments. And so what we do is we automate it. We automated all the counts, we automate all the waves, we automate all the target zones, the pullback zones, all of the historical and real-time environments, and we use custom graphics so that everything can be done for you. Now, why is that important? Because when you're trading impulses and corrections, okay, when you're trading impulses and corrections, we need to be able to mathematically map them out. And every trend is different. Now, the key here, and what I'm going to show you here today, is when you have a wave count, okay, there's 2 ways to start a bullish wave, and there's 2 ways to start a bearish wave. Now, this is the most important thing that I've learned in 10 years of wave trading. So if you're really ready to take notes, now's the time. When you're coming down in the market, you can make a lower low, break up, pull back this way, pull back this way. This is 0. This is 1. This is 2 pullback. This is 3 extension. This is 4. This is 5. Okay, if you're new to wave analysis, normally there's a 5-wave rotation in every count. Sometimes it'll go to 7, but normally after 5, it's done. Sometimes 5 doesn't even continue. Now, the other way to do this is down, down, higher, low, break, pull back. The problem with this is that this is 0, this is 1, this is 2, this is 3, this is 4, this is 5. In these scenarios, you get more opportunity. Most traders don't realize that. Most traders think that this is wave 2, when really it's, you need to know where the wave count starts. That was the biggest aha moment for me as a wave trader, when I realized the rotation of the lows or the rotation of the highs, okay? Right? The difference between the two is that the higher high break or the lower low break is the best one to be using, because you get 2 times more opportunities. You get more opportunities to trade the impulses. You get more opportunity to trade the corrective waves, and you get bigger follow through. Now, that being said, today what we're going to realize is that wave 1 is the hardest wave to assess. In fact, wave 1 is the most difficult wave to trade in a wave, because you don't know you're going into a trending environment until you actually prove wave 2 pullback. So once wave 2 pullback proves and wave 3 starts, once wave 2 pullback proves and wave 3 starts, what ends up happening is that you actually can identify that you're going into an impulse wave. Now, normally what happens is you're going to know that here. That's where all the trend traders get all excited, is at the end of pullback 2. When the end of pullback 2 rotates, that's when we know we're going into wave 3. Now, this is what the key though is that this is on fractal markets. So this applies to every time frame, all the way from a 1-minute chart to an hourly chart to a daily chart. It doesn't matter. You got to realize that there's waves inside of waves. And so we could have 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, break, 1, 2, break, 1, 2, 3, 4, 5. Right? You could have 5 wave counts in an entire big impulse. And that's the thing about using higher time frames to help smaller time frame systems. So one of the things that we do in our trading strategies is that we use the wave counts on the higher time frame first as our primary, and then we identify the trends on the smaller time frame as our secondary, because that way we know that if we're going to be trading long bias or trading short bias, I really only want to be trading the trends if I can get it in wave 1. Most likely you don't. I want to trade these, and I want to trade these in directional markets, because they're the strongest trades. And if you're a reversal trader, a lot of times you'll trade the lows in here. You'll try to catch these lows in here as the market rotates. Now, that goes both ways. Like, I would want to trade the trends on the wave 3 and the wave 5. If you can catch it on wave 1, that's great. But the concept is you need to know what wave you're in order for this to really make sense. So what we do is we automate that entire process. This is a fully automated wave count. So our software will automatically project the numerical counts: 2, 3, 4, 5. We project where they become invalidated. We project where they have to hit limitations. We project where they have to be validated. We project the target objectives for the extension zones, the pullback zones, the target zones. Like, all of this is mathematically done so that you never have to do it. And the reason that's important is because that's this wave count. Maybe we had a trend that was just like this. Well, then this entire mathematical would be different. And we'll take a look and we'll talk about how that looks on a chart here. Let's go in and take a look at this chart. So here's a 30-minute chart of the NQ, okay? Now, I can already tell you right now that it just really depends on where the wave count starts. If I'm not using wave software, I would then be looking at this high to count the rotation. 1, 2, 3, A, B, C. This is in a rotation, and it's trying to break down right? If we were starting a wave count here, if we were starting a wave count here on the lower low, 1, pullback 2, wave 3, this could all still be pullback 4 technically if we were starting it from down here. And it really depends on how you want to calculate this, because for me personally, this is a 30-minute chart. So if I'm going to be scalping or day trading on a smaller time frame, then I really want to pay attention to the higher time frames. So since structure is down, I can already see that structure is down right now. Our software will tell you that. It's easy to see that, but it's nice to know it. When structure is down, what I normally tend to do is I normally tend to look at bearish wave counts, okay? So right now, if structure's down, that means the bears are closing lower on the lows, which tells me that I can actually rely, okay, on bearish wave counts. So on the NASDAQ right now, just knowing that the structure's down on this market, I would then look to see where I am in the rotation. It's very simple. I just want to know where I am because I want to know how I'm going to approach trading this market. If I'm going to use wave counts to tell me what side of the market I should be trading on, bigger picture structure is down, which means that we're closing below the lows. In fact, what this means is since we came here, we closed below here. We never could break and close above the highs. We could never get above it, which is very bearish in the overall grand scheme of the bigger picture. So what that means to me is I would look at, okay, this is 0. We just got into limit 1 and we pulled back into wave 2 here. So we're trying to break into wave 3. Like this is 0 to pull back 2. 3, A, B, C could break down in here. It could change like this. So what we're doing here is I really want to be participating in shorts right here to the downtrends on the smaller time frame because I'm in an impulse wave right now. Can you give me a yes if you guys kind of understand that? I don't expect you to get it right off the hop. Sometimes it can be a little bit to take in on the first round, but I just like to ask if you guys understand that to some degree. Okay. You could take a look at the Euro USD. I would take a look at the Euro USD for a second, and I would actually take a look at the Euro, and we could say, hey, we're clearly in an uptrend, but we just broke the structure up here. And if we look at the uptrend wave count, okay, we just took out structure to the high again. Before I do that, I want to put on historical counts. I really want to go in here and I want you to see where the wave count started on the last rotation. And this comes in here, this is 0. This was pullback 2, but we never got there. In fact, we grinded our way up all the way to validation of 3. Okay. And that's the thing. Now we can change this to be a little bit less responsive. I can go in here and I can actually change the strength to 2, make it a little bit easier to see that. So it's a little less zigzaggy. And that way you can see the full rotation is that we moved into wave 3. Like this was all a big impulse. And you can see that in this impulse from here to here, there was many uptrends inside of that 30-minute that we could be day trading, right? How do you identify the outset of wave, 0 wave? As it breaks the structure. So I already covered that. So basically you have 4 ways to assess a wave count. You come in here, 1, 2, lower low break up, 1, 2, higher low break up. This would become 0. This would become 0. Or you have 1, 2, break down, higher high breakdown, or lower high breakdown. This becomes 0. And that's the only 4 ways you can actually identify that. Because there's only 4 ways a market can rotate like this. Or you could have double bottoms, but then this still becomes 0. Double top, this still becomes 0. So the key here, though, is not to get too confused about all that because you don't actually have to worry about that when using this. It does it for you. It does all the heavy lifting. Now, if we take a look at where we're at on the last rotation, 0 to 1, pull back all the way up to 5. We pulled into wave 5. Now, I want to go back to the NQ for a second because we're going to stick on the NQ for a second, and I want to go in. I want to talk a little bit now about how we can use this to your advantage for trading. The wave counts to me are, I really like using wave counts for big picture analysis because it'll tell me where to trade the smaller time frame direction. And when you think about wave analysis, there's a few different ways you can trade waves. You can trade waves as a bias. I personally don't believe in wave trading from an entry system. Now that's only 10 years of building 45 trading systems and 30 products on 3 platforms, but I'm not sure I'm experienced enough to weigh the opinions of maybe some wave traders. I have yet to find anybody very, very successful just trading wave pullbacks or just trading the trend pullbacks. And the reason I say that is because everybody in the world can see it. Everybody in the world knows the mathematical waves. It's no secret. There's no defined edge to that. So it's just areas. But there is defined edges in understanding the count of the waves and how you participate within them. And that's why I use waves as a bias, so that I will know that I may not take trades in the pullback levels, but I will definitely have an understanding of how I want to participate here and here with our strategies inside smaller time frames, because that allows me to use the waves as a filter for trading systems on smaller time frames. Now, when you say use it as a filter, well, that would mean that you would need to have an entry strategy, and that's what the Fibs are for. So the Fibs, okay, the Fibonacci levels can be used on multiple time frames, but I'm going to apply them on a smaller time frame chart within the wave count so that we can understand how they work and what we're doing. Okay. Now, the problem with Fibonacci is that a lot of traders don't really know which Fib to draw because they struggle drawing them correctly or where to even enter using them, right? So if you're having a hard time picking levels because you're thinking this swing should be used versus that swing and this and that retracement to this high and that extension, that's the nightmare of trying to figure out, well, which one should you use? And we eliminate that problem 100%, because what we do is we don't use one measurement of Fibonacci. In fact, we would never want to, because like I said, with the waves, everybody can see it. And if everybody can see it, we all know who can trade against it: the liquid market makers who are making markets, right? Like if everybody knows Fib levels are there, if everybody knows wave counts are there, how is that really an edge? I haven't yet seen it. Okay. So what I think is understanding that traders need to think more proactively in understanding where to expect market reactions. Now, what we do is we use Fibonacci to automate the levels so that you don't have to draw them. And you'll know where they are in advance. They're automatically forecasted above and below price. Okay. You'll know where the trade plan is in advance. You'll have an understanding of when to be buying and when to be selling in advance. So you're not actually a reactive trader, you're a proactive trader. And the reason that's important is because you don't have to sit there reacting to the market. You can actually plan things in advance so you know exactly where you're getting ready to trade. Now, the key here is, like, why should we trust it? Because the biggest thing I went on a hunt for was, is belief. If you're going to get behind something, you need to believe in the information. If you don't believe in the information, it'll be really hard to participate with confidence. So what I'm going to do is I'm going to talk to you about what confluence actually means. We've developed a product that basically generates multi-time frame Fibonacci confluence using 6 measurements of Fibonacci: zigzag analysis, swings, retracements, expansions, projections, and measured moves. It's applicable across multiple time frames, multiple fractal analysis, and it's automatically dynamic to your charts. So you just load it and it automatically calculates the Fibonacci sequencing completely. Now, this is an example of what it looks like internally. If you own a Porsche, you know that the engine's crazy awesome, but you don't need to look at the engine every day to get down the street looking good and sweet and sexy, right? You just drive the Porsche, right? So that's exactly what this looks like under the hood. Is we take the Fib levels and we basically take all 6 of these measurements, we synchronize them, and we produce the most powerful levels of Fibs across whatever time frame or market you're trading. And it's auto-adapting to dynamic volatility, and it's auto-adapting to your fractal. So you don't have to worry about that. Now, you also have the privilege of pulling it in from higher time frames, but that's a lesson for a different day. Now, like I said with trust, I want to kind of go in here and just kind of explain what that would look like. So if I were to come in here and take a Fib level, and I'm just going to stay in draw mode for a second. Let's draw a retracement. Let's take it from this one. Let's take it from that one. Take it from this one. We can take it from this one. We can come over here and go to that one. Take it from here. This one, this one, this one. We could take this one all the way down. You take this one all the way down. Now that's just retracements. Okay, hold on a second. We have 6. So let's go in here, put on some extensions. Fibonacci extensions, run to pullback. There they are. Run to pullback, Perfect. Big run to pull back here to here. You say, Sean, how can you trade this way? You can't. That's the thing. It's not meant to be traded like that. This is what a quant algorithm does. So what we do is we come in here and we start looking at confluence information. And you can see where the subsets of data come together. You can see the overlap. Now, I just took a random synchronized unrelative information. Like I just pulled random fibs from random swings just to show a concept. But you can see where the fibs come together at certain areas, where the clusters of the information come together. Now, that's not for us to trade, okay? What's important is that you realize that we take all the heavy lifting and we just do this. We just plot the fib levels, because every time you have a fib level, what this does, this is 6. That's 6 levels of resistance lining up over multiple time frames. That's 6 levels of Fibonacci lining up over multiple time frames. So when I get to these levels, I really pay attention, because I know that they hold, because they're meant to hold. It's 6 different subsets of fib data coming together over fractal analysis. Now, what's really cool about this, it's a 5-minute chart, Salman. It's a 5-minute. Now, if you take a look at this, I could go into this and I could actually plot multi-time frame levels, okay? Okay, take a look at this. I'm using a 5-minute chart on the NQ. If I really want to get really big time in here, like if I really want to wait all day, but for the killer Grand Slam trades, let's just say I put a 30-minute in here and I just hit apply. Now those are 30-minute fibs confluence on a 5-minute chart. So I'm using a 5-minute chart, but those support levels are from the 30-minute. Let's say I want to pull it off a 60-minute, but pull it into, those are 60-minute fib levels in here, okay, that are coming in on a 5-minute chart. Now I'm going to show it to you on a 5-minute, because the whole concept today was scalping, day trading, and wave counts. But you can see why we would want to pay attention to these types of things, because they're quite impressive. I don't need to sit there and show you. You can see the reactions that are happening at these areas. You can see the returning points of these areas here to here. You can see that when they come up, they hit the fib, they come back to the fib. But that's not a strategy. The whole concept of me is if I'm going to use this for a strategy, I need to know that I trust the levels. Because if you don't trust the levels, any trading system you build with the tools that you're using are rendered useless. Okay? Can everybody give me a yes that you're starting to see where the magic is unfolding? We're using wave counts for bias. We're using fibs for entry. Now I'm going to give you a trading system. I'm going to bring it all together. I'm going to show you how we make a trading system, how you unfold it, and how simple it can really be, understanding the concepts of it. Okay? Understanding the concepts of it and how we want to do things. So what I like to do, and whenever I teach traders how to be efficient in trading, is you got to think in a linear process. So the linear process is, we want to look at the higher time frame first and know what's our wave count. I want to know the structure, and I want to know the directional bias of my market. So if I'm looking for longs or if I'm looking for shorts. Then I can move to the smaller time frame. I can look at what is my wave count, and I can also look at what is my trend direction. And then I'll know whether I want to take a fib resistance trade or a fib support trade. And what's really cool about this is that you could literally take this right out the gates. You wouldn't even need to be in any of our educational programs or our trade rooms. And just with the information I've given you today, you could literally go and start trading this so simply. That's what I love about this topic, is that it really allows you to just take it and run with it. Now, the trade management is about entry, exit, and management, and that's what I'm going to do. We're going to go over and take a look at some trades. So I'm going to look at the NQ today, and we're just going to go from the break of structure. So let's start over here. Let's start over here in this environment, and let's just take a look. I'm going to turn off all the wave counts for a second. Okay, and let's just go to the NQ and let's take a look at yesterday. So we started in yesterday. It was a pretty oscillating market the last couple of days in the bigger picture, but nonetheless, Okay, nonetheless, if we go and we take a look at yesterday from the open of yesterday, okay, let's take a look here. And I like to look at it from like 8 o'clock in the morning because most traders are coming in pre-market 8 o'clock. You got news sometimes at 8:30, 8:15 on the NASDAQ. So there it is, okay? Now, a couple things. This is a 5-minute. So what I can do in here is I can actually decide how I want to participate in this, right? And I can decide, you know, where we want to go in this environment. If I take a look at this location right here, on that bar, we change structure, right? So this is the beginning start of an impulse wave, right? This is a lower low going to 1. So we don't really know we're going into a trend at that time. We don't really know we're going into a wave, or we're going into a full pullback 2, wave 3, pullback 4, wave 5. We don't know that yet. It could very well go like this and boom. That's what happens with the market, right? We don't know that. But what we do know is that we broke the structure so that this looks like it's forming wave 1. So if we're looking at it like this, we know, okay, we know that that is the beginning start of the market or of this rotation, okay? So in situations like this, a couple things we can do is we can check the granularity of the fibs. If I want to make the fibs stronger or weaker, what I'll do is I'll come in and I'll actually change this to smallest and try to locate some fibs here. There we go. A little bit more fib levels because I have the ability to take every fib that I choose to, okay? So what we're going to do in here is we're going to just go fib to fib. We're going to just look at the trend trades because the whole concept is that I know that the higher time frame is up here. We closed above structure, structure's up. We're going into wave 1. That would be considered wave 1 here. In fact, if I put the wave count on, it would be, well, it's because we need to change here. It needs to pull back 2. So this would be, and I need to change the swing setting, excuse me. Yeah, so this is pullback 1 into 2. Okay, so this is the whole concept, right? And I like to let the software do it for me, but I also like to teach you how to do it. I like to be able to show you so that when the software does it, you understand it. I really believe that learning it is really, really important. And then when you apply the waves and it does it for you, you understand what it's doing. Okay. Now, that being said, if we know that this is an impulse leg and it pulls back, then we know that if it goes back up like this, then it's a trending leg. So we could trade bounce trades coming down on the fibs, and we could also trade longs going up here. These would be considered reversal longs. These would be considered trend longs. But we're always trying to go long because the higher time frame is up, so we're trying to trade support to the upside. Now, a couple things you want to know about any support or resistance trading is that it's literally about ATR. If you've got a support level, I need you to pretend that there's a buffer around it. Most people don't know this, developers do, because we build code to read it. So this is like a buffer zone. If you have a structure level that comes like this, breaks above it, sometimes it touches it and reacts. Sometimes it comes up and it comes halfway to it and it reacts. Why did it stop here? Because of the volatility buffer. So when we look at fib trading or any type of support or resistance trading, we want to understand that we have the ability to locate those. Okay. So this is exactly what we do. We can locate the buffer zones of those rotations, and we can actually show you that this is an environment where we would start to plan the long. Now, depending on your stop placement, it's really dependent on, you know, how you want to targets. You know, it depends on how big you want your targets. Okay. And you can set your stop losses however you choose to. Let's put the stop loss in ticks. Stop size here, 10 ticks. There we go. We'll make them a little bit bigger, just like that. And it's really about that. We could do ATR. If you do an ATR stop, so stop loss one times the ATR. There it is. okay? And you can see price, you know, it might be too tight. Like, I don't like to have stops that tight, okay? I don't like to have stops that tight on the NASDAQ because the NASDAQ's a very whippy market, right? I would prefer to have, you know, a little bit more of a wider stop, just because, you know, to me, it's a smarter thing on a more volatile market. Like the S&P is a slower market. Gold is a more whippy market, right? These types of things you would understand about the markets that you're trading. Stop placement is an art form. It's not a science, but I like to use volatility stops because fixed stops on markets are kind of dangerous depending on if you know what you're doing. And the thing here is that an ATR stop allows you to use a buffer volatility. So a couple things we would do here is we could see if price tries to come up. This one here didn't lift in here. It was a lower high rejection, but you're going to see when it came down to the next buffer zone, okay, this one here rotated up here, hit the fib. I personally don't trade these reversals, and I'm going to explain why. Because the whole concept of today's lesson is trend trading, using for awesome trend trades. So to me, these are not trend trades, and it's harder to trade reversals. And that's why I want you to not take these levels, and I want you to catch the trend on the way up. That's the whole key, is trading the impulse. Okay, when it stops here, when it stops in here like that, okay, and we get above this trend here, wait for it, wait for it, wait for it. Wait for it, wait for it, wait for it. We're still on a downtrend. We're not trying to catch the knife here. Okay. Now, this is the answer. Trending. Wave 1, pull back 2. Wave 1, pull back 2. Pop, 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 pop. We want to catch the fibs on the way up. Why do you think that is? Because it's a trend trading system. And trend trading is a much easier process than catching a knife. So do you see the buffer zone right here? Right there. That's your entry. There's your target. You're trading a directional market in the direction of the wave count. Directional system in the directional market. See, the thing about counter-directional trading is you don't know how much movement you're going to get off each bounce, right? You don't really know. And that's where a lot of reversal traders that trade bounce trades will trade for like risk 1, but they'll make 0.5 because they know that if they're fighting a market, they're only going to get a little bounce. They're fighting a market, they may only get a little bounce. They're fighting a market, they may only get a bit of bounce. So counter trend traders aren't looking for impulses. In fact, we would actually manage this trade with bigger target objectives because it's an impulse. So if you're trying to trade bigger trades, okay, if you're trying to catch bigger trades, then you trade directionally because you never know if you're going to call the low on the reversal. And that's the hard part about reversal trading. So if we were to go in here, you take a look. Can you elaborate more on the buffer zone if possible? Yeah, I can do that in a second. So we wouldn't enter on the retest because we don't enter the zone after it's done. And if the market drops back down in here, okay, the market dropped down here, you'll see this, we never went back into that. Then we pop back up. So when we break above the uptrend again, okay, what are we doing? We're going back into this market. There's the target. So when we break above the average of the trend, there's the support. You're going back on the direction. Directional trade, directional trade, directional market. Okay. Moving into the next trade location, these ones never got touched. Those are trades that didn't get touched. Gap down, didn't get touched. This would be dangerous if it came through here because we'd be breaking the average. And so this is where you just, and we're not trading at that time on the NASDAQ anyways. So you trade the directional trades. This was a big one here. Depending on how you manage that trend trade, a lot of traders will trail their stop with an average. I personally don't trade that way. I'm all in or all out at 1 or 2 targets on a directional system. Okay. And that's the key about understanding the wave counts. Now, the reason we have a buffer zone around these fib levels, guys, is because sometimes Sometimes, like, take a look. This one didn't really touch the fib. This one came close to it. This one didn't touch this fib. It stopped here. Why? Because there's an invisible force field around support and resistance, and it's called average true range. In fact, if you load an ATR indicator onto a chart, you'll know that the ATR, this ATR uses 14 periods, which is the standard for most platforms. And then what ends up happening well, it depends on the system, Ajax. Like, it really depends on trade management. Let me finish this topic on ATR and I'll answer that. So ATR period at 14, okay? 14 period will then, I would basically say whatever my average range is, I want to split this into two. So I would take half of my ATR and I would put it below it. So if it was, say, 10 ticks, then I would be 5 ticks above and below. If it was 20 ticks, then that would be 10 ticks above or below. We splice the ATR above every level so that you understand where this market's likely to catch a reaction. Now, Ajax asking a nice question. And I'm going to answer it. I'm going to ask you guys. What is the biggest problem traders face? Entering the market or taking profits? What do you think it is? Is it entry or is it profit? So you think traders have a hard time getting into the market? You're telling me that you have a hard time pressing the button to get into the trade. I'm here to challenge you. Anybody can hit the entry button. Most people don't struggle getting into the market. They struggle to exit for a profit. Most traders have a hard time taking profit. And the reason for that is because they're really quick to get in, or they can get in no problem. But the problem is that they try to get fancy with exit strategies. Too many traders and this is just really more advanced, but well, then you need a good system, Salman, and then you should come check us out because we got a few of them. But this is a pretty straightforward one, very straightforward one. Now I'm gonna give you an example. How many people do you think try to get more than one target? Oh, I want to get T1, I want to get T2, I want to get T3, oh, I want a runner. Every one of these has a different expectancy. Meaning, your expectancy to T1 is going to be different than your expectancy to T2. Expectancy is the ability for you to be able to turn a profit on every dollar you risk. So, but the problem with that is that nobody really makes any money doing that. And that's why there's so many people buying courses and stuff and not too many people making money. And I'm going to tell you right now that your first priority as a really good professional trader needs to be getting out of T1. Because if you're able to take profit and make consistent money on one target, then you know your expectancy to T1. But then and only then should you ever look at increasing target objectives, because you have to measure your expectancy from your entry to T1 will be different than entry to T2. You might have a 60% win rate to T1 and a 37% win rate to T2. If you know that, you should be loading up on T1 and not even worrying about T2 and scaling your business at T1, because that means that you're losing 23% expectancy on your win rate to T2. Now you say, yeah, but what about risk and reward ratios? What about them? If you're profitable and you're consistently profitable, it's not about your R multiple alone. It's about your ability to consistently make money. A lot of traders don't understand the risk and reward trade-off between expectancy and profit taking. And so there's no right or wrong answer. This is not that I'm right and the next guy's wrong. It's a perspective that you should think about, because what a lot of traders, yeah, exactly. You can always get in again. But here's the thing. A lot of traders will see this trade they'll take their profit here and they'll be pissed off that they missed this. Oh my God, I can't catch the big one. And your job is not to catch this all the time. If it is, you're asking a lot of yourself, because that means you're always trying to predict the market. Our job is not to predict the market. We can't predict the market. Our job is to make money in the market. And that's the difference between someone that sits at a roulette table versus someone that sits at the poker table. The poker table reads the opponents and plays against other human beings. The roulette, you're left a chance. So the concept of this is that your business needs to be out about taking profit, not worrying about missing the big moves. Take a profit on a trend trade. Take a profit on a trend trade. Get an opportunity to take the next trend trade. Okay? Catch the next trend trade here. Pop the target. There it is. Another opportunity for a trend trade on the overnight session. Okay? Boom. Okay? I wouldn't touch these anymore. Wouldn't touch that one. I wouldn't touch this one either, just because of where we are in the wave count. We're extended at wave 5. So this is already up here. I'll just explain this. 1, 2, 3, 4, 5. We do not trade against the 5th wave count ever at the end of the large higher time frame wave, because you're asking for big problems. You're trying to trade a smaller time frame trend at a higher time frame reversal location, and it's really difficult to do that. Okay. So the key here would be then, if we know we're breaking down into the shorts here, guess what? We had trades here. That was the trend trade long. So we had 1, 2, 3 trend trade longs. This is a 5-minute. It's quite slow for scalpers. If you want to use smaller time frame, you could use 1 minute, scalp a lot more trades. You could be on a different trend completely. Now we're going to look at the bearish wave count, and then I'm going to give you guys some free stuff so that I don't go over my time. Okay. Now what we're doing is we're in a bearish count. You see right up here, let's turn the shorts on. Okay. Now the big thing here is that this is above the average. You need to be below the average. You cannot be breaking above the trend. That's the thing about the average here, is that you're above the trend. So you do not short as you're above the trend. You have to be below it. So this to me is not a trade. I would need to break back down. I wouldn't touch the long up here. Right here, this is a trend. Do you see how it breaks below the trade average again, and then it pulls back into this? This is a structure break going below the trend. Wave 2 pullback. Higher high, wave 2 pullback. You can apply the wave software actually to this chart, and our software would count that as 0. This would be 1. This would be wave 2 pullback. You're going into an impulse here. And that's why it dropped. Right there, there's your target. And that's a day trade. That's a scalp trade, 5-minute scalp trade, okay? Breaking above the average, we don't touch it again. Breaking below, bigger trades. Pull back, drop. You can see what happens when we break below the resistance on the right side of the trend. Entry area, impulse trade, impulse trade. That's the whole concept of being on the right side of the wave count. 0 to 1, 2 to 3. You want to be on the shorts of the impulse so that you're trading the trend in the right concept of the higher time frame. So if we just drew a little line in the sand here, so you guys can see this, as soon as we took out that low, that's when we became really aggressive to the short side, which is why this trade was massive. Right here, boom. Massive for a day trade, like a scalp trade. Like when I say day trade, like there's a target here. We catch T1 there. There's a target here. Okay. Take a look at the re-entry. You're in the right side of the impulse, guys. Re-entry on the other side of that average. Now, let's count the waves. 1, 2, 3, 4, A, B, C, 5. Our software will do this. Just a 20, Salmon. Like super, super simple, brother. Like that's the whole thing about the system. I'm just looking at waves. I'm just looking at fibs because it's a directional system with a directional market. And we don't trade pullbacks after wave 5. You don't touch it. Why not? Because it's the end of your trend. The trend is over, my friend. We wait for them to break back up. Okay. And I would not trade the longs here. I would wait for them to break back down again on the short side. Right here. There's the entry. Where was the stop? Stop was here. It came back down to, I don't think this one hit target today. This one was tight. This one would have been a pretty tough go. We could say that was a stop out because it did pop back up. Yeah, it did pop back up. So that was a stop. But the rest of them were pretty clean. Right, guys? So let's kind of do this. Lots of information to cover. I get it. We can apply this for futures, Forex, stocks. I could go over anything you want, but don't have enough time. As a gift for you, if you guys like cool gadgets and you like to have things to your phone, okay, download the app. I built a mobile app. We send the fibs to your phone. There's a free app, guys. Download that app. It'll send you fib levels, stocks, futures, Forex. You'll get delayed data on the free version. You can pay for an update on the data if you want real-time signals to your phone. It only goes down to the 5-minute. Anything less, we bog down our servers. We can't get less than 5 minutes. So, but we've got supply and demand zones in there, fibs, momentum, divergence, you name it. It's pretty awesome. And it's free, you know, if you want delayed data. And if you want the real-time alerts, you can get a data subscription. But either way, guys, it's free signals to your phone, and the fibs are part of that. So take a look at that. I'll put it in the chat box. There we go. There it is to you guys. Okay. And I'm going to go over the offer for the software because normally we don't do bundle savings like this. Like it's a really, really big deal. The reason we're doing this is to kind of complement David's request on a waves and a fibs event. Normally we break these into independent products, but the waves software and the GF system normally we'll retail our traders around $2,700 for both products lines, for both indicator sets, both systems, because they're not just indicators, like they're big systems, like drop-down UI controls, full trade plan applications, everything. And so we'll give you 40% off the entire software bundle. It's good for 2 computers. It comes with comprehensive training, usage and settings videos. We'll install it for you if you want. If you don't use Ninja, okay, if you don't use Ninja, you can get Ninja for free on a free demo feed as well, and it'll work, okay? There's an offer that David just put in the, okay? And if you have any questions or you need any assistance or you just like to join us, there's a link, but then there's also an email in there. And if you guys want to come trade with us, we've got an active trading room that runs every week, and we use these tools in our trade room very actively. Very, very actively, guys. But I wanted to put this presentation together specifically for this event because it was David's request on waves and fibs. So did you guys learn something? Give me a yes that you found that at least somewhat interesting to learn a little bit more. And if you want to automate waves and fibs, you can do it. We can definitely provide you the tool sets to do it. And we will send out a recording, so you'll definitely be able to look over the frameworks and the system. Very simple, very clean, very easy. And look forward to trading with you guys. Look forward to hearing from you. And thanks, David, for having us in here. Appreciate it.